Let's talk about one of the hottest ETFs that's gaining traction among investors. The Invesco S&P 500 Momentum ETF, ticker symbol SPMO. First, talk about all the buzz surrounding it. This ETF has a 5-star rating from Morningstar. That's quite the impressive accomplishment. Let's also talk about their recent performance. 2024 saw the S&P 500 give an amazing 25%. But guess what? SPMO destroyed that. They had a return of nearly 2x that, returning 47% in 2024. In the past 5 years, they've returned 129%, and all time, they have returned nearly 300% just in capital appreciation. That is absolutely unreal. And we can see a lot of people have started to pour money into this fund. In the past year alone, $4 billion have went toward this Invesco product, as more and more people realize this ETF might be the real deal. But what makes this ETF so special? We already know that Invesco makes great products. They do run the very popular triple Qs. That is one of the most traded ETFs every single day. Now, SPMO, it is not an income ETF. This is a growth-based ETF. It is based on the S&P 500. It is named the Invesco S&P 500 Momentum ETF after all. But what does momentum mean in this context? Does it mean that this ETF has ice in its veins, that it's going to become a clutch performer in our portfolio? Well, momentum is all about riding the waves of recent performance, assuming what's been going up lately will continue to go up. It tracks the S&P 500 Momentum Index, which means it's holding the 100 stocks with the most momentum out of those 500 stocks in the S&P 500. When we look at their top 10 holdings, we have fantastic, well-established companies. These are highly profitable companies. Companies with large moats. These are industry leaders. We got companies like Amazon, Nvidia, Broadcom, Facebook, Berkshire, JP Morgan Chase, Eli Lilly, Costco. Costco's about to feel the wrath of labor unions. Those $5 rotisserie chickens are about to cost a lot more. They have other companies like Walmart, GE Aerospace. So 101 total holdings, the top 10 make up 58% of this fund. It's also pretty diversified across several different sectors. We got technology at 24% and financials at 23%. So this is actually a little less tech heavy than the S&P 500 at the time of this recording, because it actually has more weight toward financials in general. Now, this is something that you don't see all the time, since big tech dominates most growth ETFs. If you look in most of these growth ETFs, they have like 50% of the portfolio plus is tech companies. Again, I want to emphasize how well this fund did in 2024. It had nearly a 50% return. So many of you are asking, why not just SPMO and chill? Unfortunately, right now, Netflix is not part of the 100 stocks in this fund, but they might be one day. So why not just hold SPMO as a core holding? Well, remember, core holdings is the foundational building piece of a portfolio. If you're building a house, you want to ensure that it's built with strong, stable companies that have a history of performing well and the belief that it will be sustainable for the long run. Now, satellite positions, they could be a little bit more adventurous. They're like that wild card in a portfolio, where one is trying to get an edge over the market. Let's go over some of the pros and cons to where SPMO might land. If interest rates continue to stay high, bank stocks will continue to do well, and SPMO will do really well as a result, since it has high exposure to the financial sector. But then again, remember that past performance does not predict future performance. Just because the fund did well in the last year, that doesn't mean it will necessarily do well this year. Momentum is widely unpredictable. Also remember that SPMO, it only holds 100 positions. Well, that might sound like a lot. Just remember, there's a lot of ETFs out there, like VT Sachs, that own over 3,000 stocks. So when you're looking at it from that perspective, holding just 100 different stocks is actually not a lot. And remember that SPMO is very top heavy, so 10 companies are making up well over 50% of this fund. If any of these companies do poorly, that means the fund in general is going to take a bigger tumble than the more diversified ETFs. Now, the companies that SPMO holds, they're going to be constantly changing. It actually gets reconstructed and rebalanced every 6 months, once in March and then again in September. The ETF doesn't allocate more than 23% of the fund's assets to any one sector. So this blocks this ETF from just becoming very tech heavy like other ETFs. Now, this whole time we keep mentioning momentum. How are they actually measuring momentum? Well, momentum scores, high level, they're calculated based on price changes from the previous 12 months and price changes from the previous 6 months, and then that gets divided by the daily standard deviation. It then gets weighted by market cap, and that gives you a momentum score. If that was hard to follow, I wouldn't worry about it too much. They're basically just looking at the biggest top performers in the past 6 months. And they do all the screening and buying and selling of stocks for us. They do this for a super low expense ratio of just 13 basis points. That is super cheap. That's only $13 for every $10,000 invested. That is not bad at all. SPMO has been out since October of 2015. They have also given an average return of 17% a year since then, which is not bad at all, since that's actually 3% higher than the overall market in that same time span. So they have outpaced the S&P 500 since 2015, basically the last decade. It should be noted that SPO actually did better during the market downturn of 2022 by about 8%, but it actually lagged behind during the recovery in 2023. And that makes sense, right? Since the stocks it holds have less recovering to do, since these are the stocks that did very well in the most recent 6 months, there's going to be less recovering for them to do compared to the stocks that had been beaten down even more. Now, SPMO, they do pay a pretty small dividend of about 50 basis points. So that's only a 0.5%. That's really low. Historically, it has not been a great dividend payer, but that's okay. This ETF is all about growth. There's plenty of other dividend ETFs out there to complement SPMO in a portfolio. SPMO has been paying out quarterly dividends ever since 2015, although Seeking Alpha seems to show that they may have been missing one in 2017. Now, you might notice that SPMO, it sounds pretty similar to FOMO or FOMO. That's a phrase that refers to the anxiety or fear that investors feel when they see other people making profits from an investment or a market trend. This feeling can lead them to make impulsive decisions, jump into an investment, often without fully researching or understanding it, just to avoid missing out on some potential gains. That is FOMO investing. Investors often see other people making a lot of money from it, and they might feel pressured to buy in quickly, even if it's already overvalued. This is when people buy at the top, and then the asset just goes down and they are left holding the bag. They do this because they don't want to miss the opportunity. But with SPMO, there's no need to have FOMO. It does all the FOMO buying for us while the rise might still be happening. Let me know what you think about SPMO in the comments below. I think this is one of the better ETFs out there in terms of a growth perspective. I can certainly see this being a smaller position in my personal portfolio as a way to get exposure to the momentum that's happening in the market. Thank you to all my Patreons for the continued support. Remember, my videos are always found in podcast form under the Collect Cash podcast name, and I'll catch you on the next one.
Be a better investor, invest in high yield dividend, and do it better. I challenge you to do it better. I think you can do it better. I'm absolutely confident you can do it better.